Most people think the government controls the economy. But in the United States, one of the most powerful institutions is the Federal Reserve. The Federal Reserve, often called the Fed, is the central bank of the United States. It does not print money randomly. It does not control everything directly. But it controls something very powerful, the cost of money. And the cost of money affects everything. Before we go deeper, let's understand what the Federal Reserve actually is. The Federal Reserve was created in 1913. Its job is to keep the financial system stable. It has three main goals: keep prices stable, control inflation, promote maximum employment, maintain financial stability. The Fed does not control businesses directly. It controls the environment businesses operate in. So how does it do that? The first and most powerful tool is interest rates. When the Fed lowers interest rates, borrowing becomes cheaper. Cheap loans encourage people to buy houses, start businesses, spend more money. When spending increases, the economy grows. But there is a problem. Too much spending causes inflation. Prices rise. Money loses value. So when inflation gets too high, the Fed raises interest rates. Higher interest rates make loans more expensive. People borrow less. Spending slows down. Inflation cools. This is the balancing act. Lower rates stimulate growth. Higher rates slow inflation. Now let's talk about money supply. The Fed controls how much money flows through the system. It does this mainly through open market operations. This means the Fed buys or sells government bonds. When the Fed buys bonds, it injects money into the economy. Banks suddenly have more cash. They lend more. The economy expands. When the Fed sells bonds, money is pulled out of circulation. Lending slows. Growth slows. Another powerful tool is reserve requirements. Banks must keep a percentage of deposits as reserves. If reserve requirements decrease, banks can lend more money. If requirements increase, banks lend less. Although this tool is used less today, it still affects liquidity. There is also quantitative easing. During crises like financial crashes, the Fed buys large amounts of assets. This pumps massive liquidity into markets. It stabilizes financial systems, but can increase long-term inflation risk. So how does all of this affect you? If interest rates rise, mortgage payments increase, car loans become expensive, credit card interest rises, businesses slow hiring. If interest rates fall, loans become cheaper, markets often rise, housing demand increases, the Fed influences stock markets, real estate prices, job growth, inflation, even global markets. Because the US dollar is the world's reserve currency, Federal Reserve decisions affect the entire world. But here is something important. The Fed does not control the economy perfectly. It reacts to data. Inflation reports. Employment numbers. GDP growth. Sometimes it acts too late. Sometimes too aggressively. That is why markets are unpredictable. Now here is the deeper truth. The Fed does not create wealth. It creates conditions. Businesses and individuals create wealth. The Fed only adjusts the temperature. Too cold? Lower rates. Too hot? Raise rates. Understanding this helps you make smarter decisions. When rates are low, it may be a good time for long-term borrowing. When rates are high, saving becomes more attractive. Smart investors watch the Federal. Not because it controls everything, but because it controls liquidity. And liquidity moves markets. In the end, the Federal Reserve controls the cost of money. And the cost of money controls behavior. Once you understand that, you stop being surprised by economic cycles. You start preparing instead of reacting.